High prices and high interest rates are weighing on the consumer, and the Fed members are throwing cold water on hopes that rates could be coming down anytime soon. We got a flood of Fed speak this week, all cautioning patience with rate cuts. Atlanta Fed President Raphael Bostic saying on Thursday, we got to be a little more patient and more certain that inflation is on its way to 2% before making a move on rate cuts. So how can we expect the Fed's policy to impact the consumer going forward? Joining us now, we've got Andrew Hollenhorst, who is the Citi Chief U.S. Economist here. Andrew, so many Fed speakers this morning, it almost gives even more credence to what Liz Ann Sonders over at Charles Schwab called them, the Federal Open Mouth Committee. Of course, we're going to get that printed on T-shirts. That is yet to come, and on the Yahoo Finance merch website, yet to be established. All that considered, what do you make of this Fed speak that we got in droves this week?
I think this is really what we should expect at this point in the cycle, which is a difficult point in the cycle for Fed officials. And you're making all the right points here that we have sticky inflation on the one hand. On the other hand, we have labor markets that look to be softening, a consumer that's pulling back. So they're trying to thread the needle between the price mandate and the employment mandate, trying to tackle inflation, trying to keep the unemployment rate low. And that's just a difficult thing to do. So what do you hear from Fed officials? Inflation's been stronger, so they're going to say, patience, patience, we're not going to cut yet, right up until the point when we see the data really weaken in a significant way, and then you'll get the cut. So it's really the data that's going to matter here, not what we hear from Fed officials.
Andrew, how are you looking at that PMI report yesterday? Because business activity there accelerating the fastest pace that we've seen in 2 years. So stronger than expected report here, rekindling just some of the concerns surrounding inflation. Maybe it's going to be even tougher than the market had initially anticipated, or any forecasters had initially anticipated in terms of taming inflation. Do you see any truth to that, or do you think maybe the numbers weren't as strong as what they looked like on the surface?
So I think the economy does need to cool down if you're going to cool down inflation. I'm not that worried about the PMI number showing that the economy is accelerating. If you take it very literally, that is kind of what it shows. But you want to look at it in the context of all the data. This is one survey where you ask firms, are you expanding? Are you contracting? We have hard data. We have hard data on the consumer. We see retail sales that are weaker. You were talking in the previous segment about retailers, restaurants that are cutting prices to attract consumers. So I'm really not seeing it in the broad swath of data. Yes, those PMIs were stronger. It's something to note, but I don't think it's the story of the economy right now.
What is the story of the economy?
Well, I think it's a lot of these factors that we've been waiting for to come through and slow the economy that finally are, where we have high interest rates, we have prices that have risen very significantly over the past few years. And that just hadn't slowed the economy as much as most forecasters, ourselves included, would have expected. And part of that was because there was so much excess savings in the economy, there was so much spending power, and that just kept the U.S. economy resilient and running. And now we're finally seeing that slowing. And that means the data is going to be a little bit mixed, right? We're going to get some of these reports that look weaker, some that look stronger, but the trend is towards a slowing economy now.
So, Andrew, what does that then tell us about rate cuts this year, and then looking out to 2025, more specifically, the rate of those cuts potentially next year?
So we heard a lot from Fed officials this week, maybe most notably from Governor Waller, who said, in his view, inflation will slow, but so gradually that maybe he would support a rate cut late this year, maybe early next year. And what that's telling us is that sticky inflation is making it harder for Fed officials to cut rates. And that just puts more emphasis for me on the employment mandate and what we're going to see there. If the jobs numbers hold up, then it could be a Fed that stays on hold for longer. I think we are going to see softer jobs numbers. We just see that in so much of the forward-looking data now. If they see that, then all of a sudden we'll have this pivot to the employment mandate. We'll have the Fed cutting this year. And I do think that once they start cutting, it will be a series of cuts. We actually heard that from Governor Waller, who said, this is not just going to be one rate cut and then we wait for 6 months. This will be a series of rate cuts once we get started.
Andrew, look, we came into this year, I pictured by that, at this point, Memorial Day weekend, with all the cuts that were sold to me, I'd be sitting around on somebody's lawn, maybe with some flip-flops on, and we'd have 2 or 3 cuts already by this juncture. And then that would leave to question for the rest of the year, okay, where does the consumer mindset move? Where does the employment situation move? Right now, we're hearing a little bit more from the consumer who are concerned right now over the labor markets, expecting unemployment rates to rise and income growth to slow. What will that do in terms of the pass-through effects towards the Fed actually getting towards their inflation target and reading targets in order for them to see reason to cut?
Yeah, so you thought we would be there by now. Markets thought we would be there by now. And Fed officials thought that. And they were looking at the end of 2023 at 2% core PCE inflation for 6 months. And so they really thought that maybe they tackled inflation. Maybe there wouldn't be this last mile problem. All of a sudden, we got the Q1 data in, and it became very clear to everyone there is a last mile problem. The economy has to slow inflation. And that puts the Fed in a much more difficult scenario because they can't be preemptive. They can't, exactly what you're saying. What they would like to do is to cut rates before the consumer slows down, before the unemployment rate moves up. Well, now the unemployment rate's moving up, the consumer is slowing down, and we're still waiting for inflation to come down. So it's that trade-off, the classic macroeconomic trade-off between growth and inflation. And the longer rates stay higher, the more risk there is of a sharper slowing in the economy.
All right, Andrew Hollenhorst, always great to talk to you. Thanks so much for hopping on with us this morning. Citi's chief U.S. economist. We appreciate it. Have a good weekend.
Thank you.